And we are live. Bitcoin, $66,406 right now, guys. The FOMC meeting live. We're going to be watching the press conference together because right now, these markets are more important than ever. We need to see a very bullish close here. And let me move the TikTok chat out of the screen real quick. We need to see a bullish close on the monthly today above $67,500. That is what every bullish TA trader wants to see today. Let me go ahead and write this line out, draw this line out for you guys on this horizontal times, or this line right here for you guys. So 67,500 and around $60 here for you guys. That is what everybody is hoping we close within the next 5 hours. 5 hours, almost 6 hours until the candle close on the month, guys. This is the most important FOMC meeting in history. Yes, we say that almost every single month, but that's because the markets, guys, the markets are more volatile than ever. So that is not too far away. $67,500 is not too far away. If we do close above that, which could be decided off this FOMC meeting alone, we could be looking at an incredibly bullish month of August. If we do not, okay, if we do not, we could end up seeing, unfortunately, a pretty lame August here. So today, guys, we'll be breaking down our charts, our TA. We're going to be looking over Twitter experts that are going over technical analysis. I am broken here. I am excited here because this month does matter for these markets, guys. The FOMC breaking news. I can go ahead and give you guys the rate cuts. They have not changed anything. The Federal Reserve did not change interest rates for the month of July, which was expected. We were prepared for this over the last couple of weeks. Been watching this like the NBA Finals for you all, but of course, we're leaving it unchanged at 5.25 to 5.5%. So, yeah, make sure you guys hit that like button, share the stream, get excited, and of course, get ready for what is going to be an extremely volatile 30 minutes, guys. You need to watch Jerome Powell speak. He comes on in about 15 minutes from now for the live press conference, and everything he says will decide the future of these markets here. Welcome in, Sammy. Welcome in, K-Jam. Maudo, how you doing today? Senza, Maudo, Jesse Muzzle. What's the deal with the DeFi Trade Hub? No idea. Would have to check it out for you. Chad here. Chad goes, Chad, I hope it crashes. I do too, man. Maybe there'll be some good accumulation zones for you. But hey, we all want to see markets pop. This is beyond belief. Powell should immediately be fired. Coming from DS here. Have you already repaid your followers for the hacks on your account? If you're in talks of the one that we got hacked like a couple months ago, they did a payout as well. If you have not received it, make sure you're in the Telegram and just reaching out to support. But we did filter through quite a bit of them. So if you did not get that, make sure that you're using one, the right account, and two, you're sharing, of course, the screenshots and time stamps of that actual event. But I would have to double check for the team for you, NPC 451. But yes, they did do a decent amount here. I would like a dump and then a pump. Man, isn't that what everybody wants here? Isn't that what everybody wants here? We love Tucker Carlson. How can I transact from Deck Screener to Phantom Wallet? Transact. Interesting question coming from Mark Talesman here. You can, of course, use our Telegram trading bots if that's what you're referring to. But we'll check it out there. NPC, yeah, dude, no problem, man. And again, there was a couple people that I think didn't get payback in the telegrams, but I had them like message me and they couldn't prove that we're a hack. So if it was you, man, no worries. Make sure you're just in there and have those timestamps, send them to me. And I can get you, I can help you out. No problem there in that Telegram. Past that though, guys, yes, we're going to be watching over the next 30 minutes here. And of course, over the next 5 hours, we want to watch Bitcoin close above this level, this $67,500 zone. If we can close above that, going to be very, very, very bullish for the month of August here. If you guys are on TikTok, make sure you switch that screen. You can go portrait mode, turn the phone sideways. If you're on Twitter, repost, comment, and of course, like this video. And if you're on YouTube, smash that like button, subscribe, and comment in the live chat to help us out with that media feed here, guys. We are 10 minutes away. Some really bullish things are on the charts though right now. Some very, very bullish moments. For one, the delta spread on Bitcoin is way in the negative. Way in the negative. Look at that. Let's go to max liquidity here for you guys. We are oversold massively here with a negative $13 billion delta spread. Traditionally, when we do see a negative teen delta spread here on the short positions, of course, we are looking for, on the long positions, we are looking to see a short squeeze up in the markets. You want to buy in the red and you want to sell in the green. That's how this historically works. So seeing a sea of red here going into the FOMC meeting is incredibly bullish for these markets. Thoughts on H-bar here? $5 super chat from Maharoni. Thoughts on H-bar as a project and RWA narrative? I'm going to be real with you, brother. H-bar is not an RWA narrative, but Hedera Hashgraph does have a pretty decent console, pretty decent product, and I do like them. But, I am going to be more of a DAG supporter at this point. Hedera and what these smart contract protocols or these, Hashgraph protocols need to do is really figure out how they can drive volume and transaction volume to their network, how they can incentivize developers. So I'd like to see more hackathons, but I've been a fan of Hedera for a very long time, back well before they were, in the hundreds of millions of dollars. I got into H-bar first in October of 2020 at 3 cents before it ran all the way up to 70 cents. So, H-bar was a great play in the last cycle. I do believe it can perform again this cycle, but I'm not going to be looking at H-bar as one of those projects that does that 10, 50, 20x, right? Can it 3, 4, 5x? Of course, if we do get a breakout with Bitcoin. But right now, guys, what is most important on these markets, and I know you guys know this, okay? You don't want me to say this, but the reality of the situation is we need Bitcoin to break out. We need more money. We need new liquidity to enter this market. And before that happens, we're not going to have an alt season. Your meme coins are going to continue to struggle. Your, altcoins like H-bar, all of these projects, guys, will struggle as they are following Bitcoin's price action right now. So what is important is, of course, the overall health, the overall health of the economy, overall health of the crypto market here. And that is what we want to see out of this FOMC meeting, which is going to be, of course, at 2:30 p.m. Eastern in 9 minutes. So if you guys haven't already, share this with anybody that needs to watch this. We're going to be breaking down these charts together. We saw a jump here 2 days ago up to $70,200. We have now dropped from $70,200 all the way down to $66,360. And I'm going to do this live with you guys here, but let's see if we can find some imbalances on the market, because we do want to find these yellow imbalances. This is very simple for people that are coming in. Okay. If you don't know how this works, when you see a yellow line, that is a magnet. Price loves to move to that price action. You can see it was created, even though the price was down here, it broke through that yellow line very, very, very easily. That is an imbalance on that market right there for you. So none on the daily here at the 100 time frame, but let's go to the 4 hour and let's go to $50. Let's see if we can hover in and find anything that is going to be looking good. So there's one below us at $65,950. Woo, maybe we're finding some support here. Could be finding some support here. Could be finding, maybe a local bottom here, but we could fill that imbalance here. I'm very zoomed in now. Not always on the 4 hours. It filled. You want to be looking at the daily. It's very similar to your futures gaps. However, okay, the worst case scenario I see playing out here is actually a bearish FOMC meeting and a bearish outlook for the months of August. And that is going to specifically come from the futures gap here being created on Bitcoin. So if you guys type in BTC and go to the CME gap here, Bitcoin futures, we still have that massive gap below us here between $57,800 and, of course, $61K. Now, nobody wants to see this, right? I know this, chat. None of you want to see this. Nobody on Twitter, nobody on TikTok, nobody wants to see this play out. Of course, because this would mean, guys, 30% pullbacks, 40% pullbacks on some of your favorite altcoins, and a lot of you are already down on your position. So we do not necessarily want to see this. It does not necessarily have to fill. We are testing that SMA right here. Check that out, guys. We are bouncing off of it. So we could get a pretty strong bounce moving higher to the $70,000 level and see a breakout here. But again, it's not off the table. $57,000 to $61,000. Not off the table just yet. We do have good news, though. We do have good news on the Fear and Greed Index on the 24-hour. Check it out. You can see Duke here is starting to sweat. He's got his sweat here. This is the Fear and Greed Index. If you guys know how this works, you want to buy in the red and sell in the green, baby. And we are seeing retail now become more bearish than bullish. So this is a good sign, because you don't want to be at 70 or a max greed when you're looking to see a breakout. You get breakouts when you're at 50 or below on these charts here. So very important to, of course, make sure you're checking your daily Fear and Greed Index. This is FOMO.io. If you guys haven't checked this out, And of course, it's got access to all of your favorite altcoins that use different volume metrics and everything. So while Bitcoin is at a 46 fear, you can, of course, see that maybe Ethereum or your favorite altcoins might be more oversold than Bitcoin itself. You can see Ethereum here a little bit more greedy. A little bit more greedy, of course, on Ethereum here. So it might mean that Bitcoin has a little bit more dominance and a bigger breakout coming before altcoins do as well. We have looking, of course, at our Bitcoin liquidations here. And let me get some super chat questions here. Do you think Duke will hit 20 million this bull run? It's very possible if meme coins bounce back. We have built more than anything, and it soon will be completely driven by the community. We're going to have our raid tonight at 6:30 p.m. Talk about some announcements and what we're building, what we're developing, but really it's a meme coin. Duke it's a meme coin. So once meme coin season comes back, that is what you're going to be looking for. You're going to be looking for an outbreak, of course, in Pepe and all those tokens as well. Thoughts on H bar? Already read that one for you guys, but we got Duck Manning coming in. Where do you think Ondo price will be at if Bitcoin is $90,000 to $100,000? If Bitcoin goes to $100,000, $90,000 to $100,000, I think Ondo will be at like $2.50, $3. I think it's very possible for a breakout to the upside of that'd be amazing. That'd be very freaking amazing here. A lot of imbalance in my portfolio. Eyes like a hawk on the 1 minute. Oh my gosh, bro's watching the 1 minute chart. Powell can mess up any market even a day after the Dow moves 1,000 points. Yes, he can. He's got a lot of power out there. A lot of power out there. Rate cuts coming. It's going to boom. We hope so, but again, historically, rate cuts don't necessarily mean it has to boom here. On the 7-day, we are more bullish now than bearish, guys. This is what we were looking for. So we have seen that support, as I showed you guys yesterday on our live stream. We have seen more support starting to drive and accumulate around the $66,500 level. So this is looking more bullish than bearish on these markets currently. But I mean, on the 30-day is bearish. 30-day is bearish. So it's not out of the cards. I would say it's a 70-30 chance we go higher. But at the same time, again, that is a pretty big chance that we can see that continuation lower and see a lot of that imbalance on of course, the futures gap filled there for you guys. Coming from Koosh here, very interesting here. Global money supply monthly, two things that amuse me greatly. One, you could do TA on global money, and two, people think the large entities acquiring Bitcoin now are doing so because of an impeding ETF. Honestly, that's quite interesting that he's pointing this out here. But the global money supply is looking to break out, which is bullish for these markets. Very, very, very bullish for Bitcoin and everything. Now he's looking on a monthly time scale, so it's not like this happens at the snap of the finger overnight, but it is bullish, more bullish than bearish here. Josh, where can I swap my ETH on base to Ethereum? Very simple. I believe you can just simply use Houdini swap right here. So if you're looking to swap your ETH to Ethereum from ETH base, so you can just type in ETH base here. Let's go to ETH base chain. Houdini swap here, link in the description. Super simple. So you just take your Ethereum on base, you send it to your Ethereum mainnet, and you just send in the wallet you want to receive it at. But make sure, of course, you have the right Ethereum addresses in there. Very simple to do so. You can use this for like literally anything. You can switch from Sol to ETH on base. You can switch from XRP to Sol. You can do whatever you want, trade whatever you want. And they are directly partnered with Duke as well. So if you have some extra, a little bit amount of Sol or whatever it is, this is where you can pick up, of course, Duke on Houdini swap, guys. Make sure you guys go check that out. Link should be in the description below. If not, we'll make sure we add it for you, or you can find it on my Twitter. Just go to Houdini swap for you right there to switch your guys' crypto. If you want some kind of safe trade, Robinhood stock. I don't trade Robinhood stock, but going down now. We're crashing? Are we crashing? We're at 66,000 or 66,900 right now. It's actually pumping right now, my man. Oh, that's sorry, I'm looking at the futures. Futures are probably dropping right here. $66,200 here. Let me go ahead and control Z and get those back up for us. Boom. There we go. It was great seeing you at the Bitcoin conference. Yo, Blockchain Bella, how you doing? Good to see you. It was awesome meeting. It was a fun conference. Really cool to see everybody there. All right, guys, we are less than 2 minutes away. 2 minutes away. The Federal Reserve coming out and speaking here. We got, of course, not the greatest music coming out of Jerome Powell. But prepare yourself, guys. Prepare yourself to watch markets go absolutely insane here. Absolutely insane. Let me turn that down. They're getting hyped up here. They're getting hyped up here. What do you think of Lizzo? I am not a fan of Lizzo. I think she is way overweight. No, I'm just kidding. He said Lido. My bro said Lido here. So as we, Lido, I have too many thoughts on it. I haven't done the research into it too much for you to give you guys an apparent thought on it. But we have Bitcoin weekly take up and handle targets of $120,600 to $127,400. Mega bulls here. Mega bulls here. Also very potential, very possible we just trade sideways all the way through, of course, our U.S. elections here. Audio sounds weird. Pretty good. Give me a 1 in chat if we're good. Give me a 1 in chat if we're good. Give me a 1 in chat if the audio is good right there. David Sachs here. Well, lots of crazy news coming out here today. Even Joe Rogan talking about Joe Biden's height on his podcast. A lot of really cool stuff happening out in just the real world, guys. Remember, you need to go touch the grass. Before we touch some grass, though, economist Paul Krugman says Bitcoin remains economically useless. This is the same guy. This is why I just laugh when people go, "What's your college background? Did you go to school?" And then there's this guy here who's a Nobel Prize winning economist who said by 2005 or so, it will become clear that the internet's impact on the economy has been no greater than fax machines. So you can win a Nobel Prize and be a complete fucking idiot. That is the proof here. Now, he's smart in his own ways. He has a Nobel Prize, but damn, don't ever look at someone and go, you need college experience to, be smart. That's not how this works. Here we go, guys. Jerome Powell.
My colleagues and I remain squarely focused on achieving our dual mandate goals of maximum employment and stable prices for the benefit of the American people. Our economy has made considerable progress toward both goals over the past 2 years. The labor market has come into better balance, and the unemployment rate remains low. Inflation has eased substantially from a peak of 7% to 2.5%. We are strongly committed to returning inflation to our 2% goal in support of a strong economy that benefits everyone. Today, the FOMC decided to leave our policy interest rate unchanged and to continue to reduce our securities holdings. We are maintaining our restrictive stance of monetary policy in order to keep demand in line with supply and reduce inflationary pressures. We are attentive to risks on both sides of our dual mandate, and I will have more to say about monetary policy after briefly reviewing economic developments. Recent indicators suggest that economic activity has continued to expand at a solid pace. GDP growth moderated to 2.1% in the first half of the year, down from 3.1% last year. Private domestic final purchases, or PDFP, which excludes inventory investment, government spending, and net exports, and usually sends a clearer signal of underlying demand, grew at a 2.6% pace over that same period, the first half. Growth of consumer spending has slowed from last year's robust pace, but remains solid. Investment in equipment and intangibles has picked up from its anemic pace last year. In the housing sector, investment stalled in the second quarter after a strong rise in the first. Improving supply conditions have supported resilient demand and the strong performance of the U.S. economy over the past year. In the labor market, supply and demand conditions have come into better balance. Payroll job gains averaged 177,000 jobs per month in the second quarter, a solid pace, but below that seen in the first quarter. The unemployment rate has moved up, but remains low at 4.1%. Strong job creation over the past couple of years has been accompanied by an increase in the supply of workers, reflecting increases in participation among individuals aged 25 to 54 years, and a strong pace of immigration. Nominal wage growth has eased over the past year, and the jobs to workers gap has narrowed. Overall, a broad set of indicators suggest that conditions in the labor market have returned to about where they stood on the eve of the pandemic, strong but not overheated. Inflation has eased notably over the past 2 years, but remains somewhat above our longer run goal of 2%. Total PCE prices rose 2.5% over the 12 months ending in June. Excluding the volatile food and energy categories, core PCE prices rose 2.6%. Longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households and businesses and forecasters, as well as measures from financial markets. My colleagues and I are acutely aware that high inflation imposes significant hardship as it erodes purchasing power, especially for those least able to meet the higher costs of essentials like food housing, and transportation. Our monetary policy actions are guided by our dual mandate to promote maximum employment and stable prices for the American people. In support of these goals, the committee decided at today's meeting to maintain the target range for the federal funds rate at 5.25% to 5.5%, and to continue reducing our securities holdings. As the labor market has cooled and inflation has declined, the risks to achieving our employment and inflation goals continue to move into better balance. Indeed, we're attentive to the risks to both sides of our dual mandate. We have stated that we do not expect it will be appropriate to reduce the target range for the federal funds rate until we have gained greater confidence that inflation is moving sustainably toward 2%. The second quarter's inflation readings have added to our confidence, and more good data would further strengthen that confidence. We will continue to make our decisions meeting by meeting. We know that reducing policy restraint too soon or too much could result in a reversal of the progress we have seen on inflation. At the same time, reducing policy restraint too late or too little could unduly weaken economic activity and employment. In considering any adjustments to the target range for the federal funds rate, the committee will carefully assess incoming data, the evolving outlook, and the balance of risks. As the economy evolves, monetary policy will adjust in order to best promote our maximum employment and price stability goals. If the economy remains solid and inflation persists, we can maintain the current target range for the federal funds rate as long as appropriate. If the labor market were to weaken unexpectedly or inflation were to fall more quickly than anticipated, we are prepared to respond. Policy is well positioned to deal with the risks and uncertainties that we face in pursuing both sides of our dual mandate. The Fed has been assigned two goals for monetary policy: maximum employment and stable prices. We remain committed to bringing inflation back down to our 2% goal and to keeping longer-term inflation expectations well anchored. Restoring price stability is essential to achieving maximum employment and stable prices over the longer run. Our success in delivering on these goals matters to all Americans.
Jerome, you're not
we
pumping my
understand
bags.
that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you. I look forward to your questions.
Oh, God.
Gina.
Did you change your mic a little bit? Huh? Did you change your mic?
Gina Smiler from the New York
It
Times.
just sounds
Thanks for
like
taking our questions.
Didn't sound like-
Markets pretty much entirely expect a rate cut in September at this stage. I wonder if you think that's a reasonable expectation, and if so, why not just make the move today?
Thank you. So on September, let me say this. We have made no decisions about future meetings, and that includes the September meeting. The broad sense of the committee is that the economy is moving closer to the point at which it will be appropriate to reduce our policy rate. In that, we will be data dependent, but not data point dependent. So it will not be a question of responding specifically to one or two data releases. The question will be whether the totality of the data, the evolving outlook, and the balance of risks are consistent with rising confidence on inflation and maintaining a solid labor market. If that test is met, a reduction in our policy rate could be on the table as soon as the next meeting in September. So you asked why not today, and I would just say, again, that the broad sense of the committee is that we're getting closer to the point at which it will be appropriate to reduce our policy rate, but that we're not quite at that point yet.
Howard.
So just to follow up on that a bit, if inflation behaves as you expect between now and September, would you regard a cut in September as sort of the baseline scenario right now?
So I guess I would think about it this way. I'll give an example of cases in which it would be appropriate to cut, and maybe that it wouldn't be appropriate to cut. So if we were to see, for example, inflation moving down quickly or more or less in line with expectations, growth remains, let's say, reasonably strong, and the labor market remains, consistent with its current condition, then I would think that a rate cut could be on the table at the September meeting. If inflation were to prove, stickier, and we were to see higher readings from inflation, disappointing readings, we would weigh that along with the other things. I think it's going to be not just any one thing. It's going to be the inflation data. It's going to be the employment data. It's going to be the balance of risks as we see it. It's going to be the totality of all of that help us make this decision.
And just to follow up on that, specifically,
thank you.
in what ways right now, given all you've seen over the last
that
few
on,
months,
so it should
in
be better now. It should
particular
be better.
on shelter, on
I
services,
appreciate it.
etc. In what ways are you not confident right now that inflation is on the way back to 2%?
I think it's just a question of seeing more good data. We have seen the last couple of readings have certainly added to confidence, and we've seen progress across all three categories of core PCE inflation. That's goods, non-housing services, and housing services. So it's really just, we had a quarter of poor inflation data at the beginning of the year. Then we saw some more good inflation data. We had 7 months at the end of last year. We just want to see more and gain confidence. And as I said, we did gain confidence, and more good data would cause us to gain more confidence.
Colby.
Thank you. Colby Smith with the Financial Times. The March SEP pointed to 3 cuts in 2024 with core inflation at 2.6% and the unemployment rate at 4%. Since we're now at that level in terms of inflation and already beyond what was projected for the labor market, I'm just wondering if that rate path is back to being
a big
the
ass
best
mic,
guidepost
dude.
for policy rather than, let's say, the shallower one laid out in the June SEP.
So I would just say, really the path ahead is going to depend on the way the economy evolves. And I can't really give you any better forward guidance on it than that. We didn't, of course, do an SEP at this meeting. We will do another one at the September meeting. I would just say I can imagine a scenario in which there would be everywhere from 0 cuts to several cuts, depending on the way the economy evolves. And I wouldn't want to lay out a baseline path for you there today. I've said what I can say about September and about today, though.
Pump.
Nick
Guys,
Morales, Wall
spam
Street Journal.
pump in the chat. If you
Sure,
want
Powell,
markets
you've
to
said
pump,
before that you
you
wouldn't
have
wait until
to hit
inflation
pump.
got to
Pump,
2%
pump,
to
pump.
cut rates because of how inflation
Pump,
is
pump,
lagged.
pump.
Does that apply for the
We have to
labor
close
market
above
too? If
67.5
the labor
today.
market is back in equilibrium, why is restrictive policy and potentially very restrictive policy, given the high real funds rate, warranted right now?
So this is the very reason that we're thinking about that we've said in our statement that we're going back to looking at both mandates, and that we think the risks are coming back into balance. We think what the data broadly show in the labor market is an ongoing gradual normalization of labor market conditions. And that's what we want to see. We've seen that over a period of a couple of years, and a move really from overheated conditions to more normal conditions. We are watching the labor market conditions quite closely, and that's what we're seeing. If we start to see something that looks to be more than that, then we're well positioned to respond. That's part of what we're thinking.
And when you talk about seeing something that's more than whatever softness or slowdown you expect, in the past, you've said that stronger growth wouldn't override better news on inflation. I wonder how that cuts the other way. If you're seeing more softness in the labor market than what you would expect, does that change the calculus on what you're looking for out of the inflation numbers to recalibrate policy?
So we have growth isn't one of our three. We have 2 mandates, as you know. The labor market, maximum employment is one, and stable prices is another. So we weigh those 2 things equally under the law. When we were far away from our inflation mandate, we had to focus on that. Now we're back to a closer to even focus. So we'll be looking at labor market conditions and asking whether we're getting what we're seeing. And as I said, we're prepared to respond if we see it that it's not what we wanted to see, which was a gradual normalization of conditions. If we see more than that, and it wouldn't be any one statistic, although of course the unemployment rate is generally thought to be a good single statistic, but we'd be looking at wages, we'd be looking at participation, we'd be looking at all the things, surveys, quits, hires, all of those things to determine the overall status of the labor market. But we're looking at it now. I would say, again, I think you're back to conditions that are close to 2019 conditions, and that was not an inflationary economy. Broadly similar labor markets then. I think core inflation was actually running below 2%. So I don't now think of the labor market in its current state as a likely source of significant inflationary pressures. So I would not like to see material further cooling in the labor market. And that's part of what's behind our thinking. The other part, of course, is that we have made real progress on inflation, and we've got growing confidence there that we are not quite there yet, but we're getting more confident that we're on a sustainable path down to 2%. So those two things are working together, and we're factoring those both into our policy.
Chris.
Chris Rugaber at Associated Press. You mentioned not wanting to see any further cooling in the job market. Why not, or would you consider preemptive cuts to prevent if you saw risks of an unexpected cooling? Is that something you would cut ahead of time for?
So I wouldn't say I wouldn't want to see any other cooling. It would be more of a material difference. If we'd be looking at this and if we see something that looks like a more significant downturn, that would be something that we would have the intention of responding to. So in terms of, I don't think of it that way. I think of it as, we're actually in a good place here. We're balancing these two risks of, go too soon and you undermine progress on inflation, wait too long or don't go fast enough, and you put at risk the recovery. And so we have to balance those two things. That's the nature of having two mandates. And I think this is how we balance them. It's a rough balance, but it does feel like that. Again, the labor market feels like it's in a place where it's just a process of ongoing normalization. 4.1% unemployment is still historically low, and we'll just have to see what the data show us.
And just to follow quickly, wanted to see what you thought of the recent JOLTS report, which did show gross hiring has come down even below 2019 levels. Layoffs remain low. So it painted a picture of a very static labor market. Is that sustainable in your view or something that is worrying? Thank you.
So I think all of the data points continue to point to kind of the direction we would want to see. So that was taken as there was a decline in job openings. That was good. Today's ECI reading was a little softer than expected. So that's a good reading. It shows that wage increases are still at a strong level, but that level continues to come down to more sustainable levels over time. That's exactly the pattern that we want to be seeing. So I think the data we've been seeing in the labor market are broadly consistent with that normalization process. Again, we're closely monitoring to see whether it starts to show signs that it's more than that.
Steve.
Steve
I'm on to something with it.
Mr. Chairman, back in March, you talked about cutting rates as a process, and in June, you talked about the idea that, one rate cut wouldn't do anything. So I wonder if you can sort of follow up on Colby's question. Talk about, are you weighing the economy right now in terms of its ability to withstand multiple rate cuts? Talk us through the process that you're thinking, or is it just one rate cut? Or are you in the process now thinking that rates need to be normalized here? Thank you.
Yeah, I can't really say that, honestly. We've seen, significant movement in the labor market. And, we're very mindful of this question of is it just normalization or is it more? We think it's just more normalization, but we want to be in a position to support the labor market. At the same time, we're seeing progress on inflation. So, we actually got to this, we raised rates a year ago at the July meeting. And if you look at the situation in the economy a year ago, inflation was over 4%. It was a completely different economy. Now we've made a lot of progress, and the labor market, as I think, unemployment was in the mid threes. So it's a different economy, and I think it's coming to be time to adjust that so that we support this continued process. The thing we're trying to do is, that we have we've had this really significant decline in inflation, and unemployment has remained low. And this is a really unusual and historically unusual and such a welcome outcome for the people we serve. What we're thinking about all the time is how do we keep this going? And this is part of that. We think we don't need to be 100% focused on inflation because of the progress we've made. 12-month headline at 2.5, core at 2.6. It's way down from where it was. The job is not done on inflation, but nonetheless, we can afford to begin to dial back the restriction in our policy rate. And I think we're just as part of a process. In terms of what that looks like, I mean, I think most rate, you would think in a base case that policy rates would move down from here, but I don't want to try to give specific, forward guidance.
That should do it.
That should do it. At which it might happen, because I think that's really going to depend on the economy, and that's highly uncertain.
Rachel.
Mm-hmm.
Hi, Chair Powell, Rachel Siegel from the Washington Post. Thanks for taking our questions. On inflation, do the past few months of good reports look like what we saw last year, where you really had a lot of momentum with a few bumps in between? Would you characterize that kind of momentum as back on track at this point in the year?
Actually, what we're seeing now is a little better than what we saw last year. Last year, as we pointed out late in the year, a whole lot of the progress we saw last year was from goods prices, which were going down at an unsustainable rate, disinflating at an unsustainable rate. This is a broader disinflation. This has goods prices coming down, but we're also now seeing progress
NASDAQ's
in the other two
this.
big categories, non-housing services and housing services. So, so the thing is, you got 1 quarter of that. We had 7 months of low inflation. You got 1 quarter of this. I would say the quality of this is higher, and it's good, but so far it's only a quarter. So I think we need to see more to know that we're to have more confidence that we're on a good path down to 2%. But as I mentioned, our confidence is growing because we've been getting good data. And
Pat, are you bullish or bearish?
Report,
Bullish or
and frankly,
bearish?
the softening in the labor market conditions, give you more confidence that the economy's not overheating. It doesn't look like an overheating economy, and it looks like an economy that's normalizing.
Okay. And if we were to think about the first couple of months of the year, is there any sense now that they were these blips that could have actually allowed for earlier rate cuts, as were some of the projections going into 2024?
So the thing about if what it is seasonality, and it could just be, it's very, very hard to do appropriate seasonal adjustments. If that's what it is, then that actually implies that other months were reporting too low inflation. If you smoothed it out, it's a zero-sum game. And that's why we look at 12 months. We look at 12 months because that takes all that out, all those effects out. 12-month now is 2.5% headline, 2.6% core. This is so much better than where we were even a year ago. It's a lot better. Now, the job is not done. I want to stress that, and we're committed to getting inflation sustainably under 2%, but we need to take note of that progress, and we need to weigh the risks to the labor market and the risks to our inflation target now more equally than we did a year ago.
Michael McKee.
Michael McKee from Bloomberg Radio and Television. I'd like to ask you about the balance of risks as the American people see it. At this point, is the risk greater to leave interest rates where they are, given the damage that higher interest rates do to the economy in slowing demand and raising prices? Or is it more important for the American people that you keep rates where they are to bring inflation down?
Guys, make sure you hit that like button.
I think that we've been given an assignment by Congress. This is how we serve the American people, is by achieving maximum employment and price stability, right? And so in our, quasi-constitutional document, the Statement on Longer Run Goals and Monetary Policy Strategy, we look at the two goals, and if one of them is farther away than the other, the two variables, inflation and employment, if one is farther away from its goal than the other, then you concentrate on the one that's farther away, and you take account of the time to reach the goal. So for the last couple of years, the best service we could do to the American people was to focus on inflation. But as inflation has come down, and I think the upside risks to inflation have decreased as the labor market has cooled off, and labor market has softened, probably the inflation is probably a little farther from its target than is the employment, but I think the downside risks to the employment mandate are real now. So we have to weigh all that. And if you think about where that takes us, is we have a restrictive policy rate. It's clearly restrictive. It's been the rate we've had in place for a full year. And the time is coming, as other central banks around the world are facing the same question. The time is coming at which it will begin to be appropriate to dial back that level of restrictions. restrictions so that we may address both mandates.
Well, you have event risk basically with the jobs report on Friday and another one before you meet again. Are you certain that you won't fall behind the curve and lead to unnecessary unemployment if you wait until September?
Certainty is not a word that we have in our business. So we get a lot of data between now and September, and it isn't going to be one data read or even two. It's going to be the totality of the data, all of the data, and not just it. And then how is that affecting the outlook, and how is it affecting the balance of risks? That's going to be the assessment that we do. Of course, we'll all look carefully at the employment report, but so much other data coming in, and so much happening between now and the September meeting, and we'll make a judgment.
Edward.
Thank you, Mr. Chairman. Edward Lawrence of Fox Business. I do want to dig deeper on what Michael and what Nick were asking. There's a shift in the statement to balance between the focus between inflation and jobs. Looking at the job sides, we've seen wage data show sort of an abrupt slowing. We're hearing on earnings calls from companies like Intel abrupt layoffs. In the jobs report from the BLS, government jobs has been a leading creator. Could the government jobs as a sector hiring mask underlying weakness in the jobs report?
Well, we'll look at everything. We've seen some tendency to have a narrowing base of job creation in some months going back, but then we've had some months where job creation was broader, and also the headline number of jobs has come down. So but you look at the whole thing, and I think you do look at private demand extra carefully. To your point about government. So we'll just be looking at all those things.
Yeah, so as a follow then, so could the Fed then be behind the curve? Because you said some of the reports last meeting, you said the reports could be noisy or overstated. Was there a discussion of what kind of discussion was there for a cut today? And could the Fed be behind the curve?
Yeah, so
I can't wait for the Fed minutes.
The objective is to balance the two risks, right? It's the risk of going too soon and the risk of going too late. We've been, we had 7 months of good inflation data at the end of last year. We said we wanted to see more. We pointed out that too much of this was coming from goods, and sure enough, the first quarter wasn't great inflation data. Now we've got a quarter that is good, and we're balancing the risk of going too soon against the risk of going too late. That's what we're doing. There's no guarantee in this. It's a very difficult judgment call, but this is how we're making it. But in terms of today, your question about today, we did have a nice conversation about this issue today. The overall sense of the committee, as I mentioned, is that we're getting closer to the point at which it'll be appropriate to begin to dial back restriction, but we're not quite at that point yet. We want to see more good data. The decision was unanimous. All
Guys, I think he wants to see more good data.
But there was a real discussion back and forth of what the case would be for moving at this meeting. A strong majority supported not moving at this meeting. That was a strong sense of the committee. But it's a conversation that we had today, certainly.
Courtney.
Courtney Brown from Axios. Thank you for taking our questions. When the Fed was raising rates, there was a lot of conversation about long and variable lags. I wonder if that applies on the way down too. How are you and the committee thinking about that?
Yes, it does. And I think the lags have kind of showed up here in the last 6 months, by the way. You really do now see the restriction. Whereas, even a few months ago, people were questioning how restrictive policy was. Look at the labor market now. You can see, and look at inflation, rate sensitive, interest sensitive spending. You really do see now that policy is restrictive. I wouldn't say it's extremely restrictive, but it's certainly effectively restrictive. Yes, the lag should be on the way down. It should take some time to get into the full economy, affect financial conditions, and that affects economic activity, hiring, and that kind of thing, and ultimately inflation. It's not instantaneous, although it's faster than it used to be because markets move now in anticipation of our moves.
So are you worried then that if monetary policy acts with long and variable lags, even when you're lowering interest rates, it might be too late for the Fed to help stave off any kind of slowdown in the labor market or broader economy?
Yeah, we have to worry about that. just to make it clear, it's a very difficult, challenging judgment, and we didn't want to go too soon. We don't want to go too late. But this is how we've made that judgment. I feel good about where we are. We're certainly very well positioned to respond to weakness with the policy rate at 5.3%. We certainly have a lot of room to respond if we were to see weakness. That's not what we're seeing, though. What we're seeing, look at the first half growth numbers. Look at PDFP at 2.6% for the first half. It's not signaling a weak economy. It's also not signaling an overheating economy. Labor market, admittedly, the unemployment rate has moved up 0.7, and we're seeing a normalization there. But wage increases are still at a high level. Unemployment is still at a low level. Layoffs are very low. Initial claims have moved up, but they're pretty stable, and they're historically not high at all. So the total scope of the data suggests a normalizing labor market. And again, we are carefully watching to see that continues to be the case.
Victoria. Hi, Victoria Guido with Politico. On the labor market, I was wondering, how worried are you all about unemployment rising to the point where it triggers the SOM rule? And would that potentially affect how quickly you cut rates?
So I would just say that the question really is one of, are we worried about a sharper downturn in the labor market? So, and the answer is we're watching really carefully for that. We're aware of that rule, which is really I would call it a statistical thing that has happened through history. A statistical regularity is what I'd call it. It's not like an economic rule where it's telling you something must happen. So again, what do we see? What are our eyes telling us? We look at all the things we're seeing, and what it looks like is a normalizing labor market. Again, job creation at a pretty decent level, wages moving up at a strong level, but coming down gradually. Job vacancies have come down, but they're still high by historical standards. So I've been through some of the data already, but what we think we're seeing is a normalizing labor market. And we're watching carefully to see if it turns out to be more, it starts to show signs that it's more than that, then we're well positioned to respond.
Is there a reason to think that the labor market might behave differently this time than it has historically?
I think, history doesn't repeat itself. It rhymes. I think that statement is very true about the economy.
Bro, just Mark Twained it?
Just the same. An example would be,
hey, yo,
a trend increase in the level of vacancies. There are many, many examples. So it's never exactly the same. Also, let's remember that this pandemic era has been one in which so many, apparent rules have been flouted, like the inverted yield curve, for starters. So many pieces of received wisdom just haven't worked. And it's because the situation really is unusual or unique in that so much of this inflation came from the shutdown in the economy and the resulting supply problems in the face of admittedly very strong demand. So the whole situation is not the same as many of the other prior inflation or downturns that we've seen, or business cycles that we've seen. So we're having to learn, we're having to, to be very careful about the judgments that we make, I would say. So we don't assume that these regularities will just repeat themselves automatically.
Amara.
Thank you, Chair Powell. Amara Mokwe with Bloomberg.
I know the question
There
is
seems
like,
to be quite
so
a difference between what the anecdotal data are telling us, such as the very recent downbeat beige book, and the hard data. Do you take those anecdotes seriously? That is, that the economy and labor market are cooling much more rapidly than what's shown in the data.
So I do take that seriously, and the beige book is great. What's even greater is hearing the Reserve Bank presidents come in and talk about their conversations with businesses and business leaders and workers and people in the non-profit sector in their districts. But I'll tell you, it's a pretty, the picture is not one of a slowing or, a really bad economy. It's one of, there are spots of weakness and there are regions where growth is stronger than other regions. But overall, it's, again, look at the aggregate data. Aggregate data is, particularly PDFP, private domestic final purchases, is 2.6%, and that's a good indicator of private demand. So we listen to all of that, and it does I think it's important to listen to anecdotal data and not just look at the aggregate data, especially, it's very hard. GDP data can be volatile quarter to quarter. So it's just hard to measure economic activity. There are it's just difficult to do. So I look at both, but I wouldn't say that the anecdotal data is uniformly downbeat. It's more mixed.
Thank you. Jolene Kent with CBS News. Chair Powell, thanks for taking our questions today. You have consistently said that the Fed does not consider politics in making decisions. With a possible September rate cut on the table, it would be less than 2 months before the election, and former President Trump reportedly said that cutting rates so close to the election is something the central bank knows they shouldn't be doing. What's your response, and do you believe it's possible to really remain apolitical with a September rate cut?
I absolutely do. And I think first of all, we haven't made any decisions. I would say it this way. Haven't made any decision about any future meeting. I don't know what the data will reveal or how that will affect the appropriate path of our policy. I really don't know. I do know how we will make that assessment. That's what I do know. So if you take a step back, the current situation again is inflation has come down much closer to our goal, and that's happened while unemployment has remained low. We're very tightly focused on using our tools to try to foster that state of affairs continuing. That's at each of our meetings and all of our decisions, our focus is strictly on that and really on nothing else, doing our part, whatever that part may be. We're using our best thinking. We're doing our best to understand the economy. We follow academics. We follow the many commentators who bless us with their commentary, but we don't change anything in our approach to address other factors like the political calendar. Congress has, we believe, ordered us to conduct our business in a non-political way at all times, not just some of the time. I'll say this too. We never use our tools to support or oppose a political party, a politician, or any political outcome. The bottom line is, if we do our very best to do our part and we stick to our part, that will benefit all Americans. If we get it right, the economy will be stronger, we'll have price stability, people will find jobs, wages will rise in real terms, everyone will benefit. So that's what we believe, and that's how we will always act. This is my 4th presidential election at the Fed. I can tell you this is how we think about it. This is what we do. So anything that we do before, during, or after the election will be based on the data, the outlook, and the balance of risks, and not on anything else.
Just a quick follow-up. Do your economic forecasts and models take into account the two very different economic plans of these two presidential candidates, Harris and Trump? And if so, how?
No, we do not do that. We absolutely do not do that. We don't know who's going to win. We don't know what they're going to do. We don't act as though we know, and we just can't do that. We basically have our forecast. We can run simulations of different potential policies, but we would never try to make policy decisions based on the outcome of an election that hasn't happened yet. That would just be a line we would never cross. We're a non-political agency. We don't want to be involved in politics in any way, so we wouldn't do that.
Nicholas.
Thank you, Chair Powell. Nicholas Jasinski from Barron's Magazine. There hasn't been a dissenting vote on an interest rate decision in some time. If the data do evolve as you expect, if you do have more confidence by the September meeting, do you get the sense that there will be a unanimous vote on an interest rate move in September? Or basically, are there meaningful differences in committee members' assessments of how much more confidence is needed?
So there are always meaningful differences. There are, and we talk a lot before, during, and after the meeting. We do have a very robust discussion of these things. You're right that in most cases, people, if they feel heard and they feel that their position has been given serious consideration, for most people, most of the time, that's going to be enough. There are dissents. That's fine. No one has a veto. No single person has a veto. So it just is a question of who will vote.
Chat, you're wild.
We've had dissents.
Keeping rates at the same right now.
We haven't had so many during the pandemic era, and it just may be that we've felt more united because we felt, under a lot of pressure to get things right. But before the pandemic, we had plenty of dissents, and dissents happen. It's part of the process. There's nothing wrong with dissents, and if it happens, it happens.
Jean.
We're going to zero. We're going to zero, guys.
Hello, Jean Young with M&I Market News. Is a 50 basis point cut as a first cut at all likely or even on the table? Thank you.
I don't want to say, I don't want to be really specific about what we're going to do, but that's not something we're thinking about right now.
Jennifer.
Of course, I haven't made any decisions at all as of today.
Thank you, Chair Bell. Jennifer Schonberger with Yahoo Finance. Not to get into the minutes, but you said there was a real discussion today for moving at this meeting. I'm curious if you could provide some more color on the nature of the discussion today at the meeting about a possible rate cut as early as September.
Well, so, the way the meeting is set up, the first day there's a discussion of financial stability because it's every other meeting we have that. And then we have an opportunity to comment on that. Then we have an economic go around. And then this morning we have the monetary policy go around. And I think in people's economic go around and in their monetary policy go around, people express their views about this. And there's a range of views. People, as you will know from the speeches that they give, people have different ways of thinking about the economy. And so, in the minutes, we'll lay this out in a much better way than I can do off the cuff. But there's a range of perspectives, and but I do think that we're a consensus-driven organization. People come together. This was a unanimous decision, and at the end, everyone supported the outcome, not just the voters, but everyone. So I would also say some people examine the possibility, the case for moving at this meeting, but overwhelmingly the sense of the committee was not at this meeting, but as soon as the next meeting, depending on how the data come in.
But there is a growing sense of confidence that you could move at the next meeting, assuming
Yes.
inflation comes.
Well, assuming that the totality of the data supports such an outcome, no question that is the case. That as I mentioned,
You gotta look for the right answer.
We think that the time it's approaching, and if we do get the data that we hope we get, then a reduction in our policy rate could be on the table at the September meeting.
Hi, Chair Powell, Nancy Marshall-Genzer with Marketplace. Former New York President Bill Dudley
the
wrote
brain of the
an
economy right
op-ed
now.
in Bloomberg earlier this month, which you probably saw, in which he said, quote, "It might already be too late to fend off a recession by cutting rates. Dawdling now unnecessarily increases the risk." Is he wrong?
So this is the judgment that we have to make, and we're well aware of the judgment. We're as I've said, we have to weigh the risk of going too soon against the risk of going too late. If we go too soon, we can, we had a lot of advice, to go ahead and unemployment is low. You know, the data overall show a strong labor market.
Guys, we got rugged.
You know, so that's really what you see. It's neither an overheating economy nor is it a sharply weakening economy. It's kind of what you would want to see, but of course,